SaaS revenue recognition sounds complicated, but at its core, it answers one simple question. When can you actually count money as revenue? Not when you receive the cash, not when the contract is signed, but when you earn it. And this is exactly what ASC 606 is designed to clarify. Let's break it down step by step, using a simple SaaS example and a timeline you can visualize. Imagine this. A customer signs up for your SaaS product on January 1st. They pay you $12,000 upfront for a one-year subscription. Cash hits your bank account immediately, but here's the key question. Did you earn $12,000 on January 1st? The answer is no. You earned the right to earn it over time. And this difference between cash received and revenue earned is the foundation of ASC 606. ASC 606 is the accounting standard that tells companies how and when to recognize revenue from contracts with customers. It applies to almost every SaaS business, whether you're a startup or a public company. The goal is simple. Recognize revenue in a way that reflects how value is actually delivered to the customer. To do that, ASC 606 follows a 5-step framework. Let's walk through each step using our SaaS example. Step 1 is identifying the contract with the customer. This part is usually straightforward. A contract exists when there is an agreement between you and the customer, approval from both sides, clear payment terms, commercial substance, and a reasonable expectation of collection. In SaaS, this is typically your subscription agreement or terms of service. Once the contract exists, you move to step 2. Identify the performance obligations. This is where SaaS companies need to be careful. A performance obligation is a promise to transfer a distinct good or service to the customer. In most simple SaaS businesses, the main performance obligation is providing access to the software over time. If you promise 12 months of access, that is one performance obligation satisfied over 12 months. If your contract also includes onboarding, implementation, or support, those may be separate performance obligations depending on whether they are distinct. For now, let's keep it simple. One contract, one performance obligation, 12 months of SaaS access. Step 3 is determining the transaction price. This is the amount you expect to be entitled to in exchange for fulfilling your obligations. In our example, the transaction price is $12,000. No discounts, no variable fees, no usage-based pricing, just a flat annual subscription paid up front. Step 4 is allocating the transaction price to the performance obligations. Since we only have one performance obligation, this step is easy. All $12,000 are allocated to providing access to the software over 12 months. But notice what this means. You are not allocating the revenue to a date. You are allocating it to a period of time. This brings us to the most important step. Step 5 is recognizing revenue when or as the performance obligation is satisfied. In SaaS, performance obligations are usually satisfied over time. Why? Because the customer receives and consumes the benefit of the software continuously as long as they have access. So instead of recognizing $12,000 on day 1, you recognize revenue evenly over the contract term. Let's visualize this. On the whiteboard, draw a timeline from January to December. At the very start, draw a big arrow pointing down labeled Cash Received $12,000. Now below the timeline, draw 12 equal boxes, one for each month. Each month you recognize $1,000 of revenue. $1,000 in January, $1,000 in February, and so on until December. By the end of the year, total recognized revenue equals $12,000. But at any point before that, some of the cash you received is not revenue yet. So where does it go? It goes to a liability called deferred revenue, also known as contract liability. Deferred revenue represents money you've been paid but have not yet earned. On January 1st, deferred revenue is $12,000, and at the end of January, you've earned $1,000, so deferred revenue drops to $11,000. Each month, deferred revenue decreases as revenue is recognized. This is one of the most common areas of confusion for founders. They see cash in the bank and assume it's revenue. But under ASC 606, cash and revenue are completely different concepts. Cash answers the question, did I get paid? Revenue answers the question, did I earn it? Now, let's talk about why this matters. First, financial statements. If you recognize revenue too early, your income statement looks inflated. If you recognize it too late, it understates performance. ASC 606 creates consistency so investors, lenders, and stakeholders can compare companies accurately. Second, SaaS metrics. Metrics like MRR, ARR, churn, and growth rates all depend on proper revenue recognition. If your revenue timing is wrong, your metrics are wrong. Third, compliance. If you plan to raise capital, get audited, or eventually go public, ASC 606 is not optional. Getting it right early saves massive headaches later. Now let's quickly touch on a few common SaaS variations. What if the customer pays monthly instead of annually? In that case, cash and revenue timing are much closer, but the principle stays the same. You recognize revenue as the service is delivered, not when the invoice is paid. What if the contract includes setup or implementation fees? You need to assess whether those services are distinct. If setup does not provide standalone value and only enables access to the software, the fee is usually recognized over the same period as the subscription. What about usage-based pricing? Under ASC 606, usage-based fees are typically recognized when the usage occurs because that's when the value is delivered. Same framework, different inputs, the logic never changes. Here's the simplest way to remember. ASC 606 for SaaS. You don't recognize revenue when money moves. You recognize revenue when value moves, from you to the customer. Over time, if you understand that, you understand the core of SaaS revenue recognition. Everything else is just details. If this explanation helped you, the next step is learning how this flows into journal entries, financial statements, and SaaS metrics like MRR and deferred revenue. And once you see those connections, ASC 606 stops being scary and starts being logical. Because good accounting isn't about rules, it's about telling the financial story correctly.